Hello, Chart Watchers, and welcome to this Wednesday, June 26th, 2019 Market Watchers live show with your hosts, Tom Bowley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we are off to a pretty good start today after having a rough day yesterday. The Dow Jones Industrial Average currently up 81 points, the S&P 500 up 7. The Nasdaq leading on a relative basis today, up about 59 points, and the Russell 2000 up 3. 10-year Treasury yield beginning to bounce once again off this 2% level. Very important area for the market to try and get this bounce in the yields, as that would signal money rotating perhaps into the S&P 500. We'll take a look at that in just a couple of minutes. Volatility index here, you can see, is down just slightly today, but the overall uptrend remains. So we do want to be careful if prices revert lower and we start setting new lows. Just keep in mind volatility is on the rise here. Energy trying to make a big breakout here above $64. The XLE is leading today. Crude oil prices up near $60 a barrel, having a very strong day. That $60 level was one that we've looked at here recently on Market Watchers Live. That has been a key pivot area for crude oil. So we want to watch that level closely to see whether or not crude oil breaks above it. The XLK technology bouncing back, getting back most of its losses from yesterday. Real estate and utilities lagging, and actually seeing that across the board today. The defensive groups are the ones that clearly have been lagging over the past couple of sessions. We've got exploration and production stocks really performing well on the jump in crude oil prices, and with that XLE trying to negotiate $64. This is the highest level we've seen exploration and production in the last month or so. Semiconductors also having a huge day, and the big reason, Micron beat on their top line, beat on their bottom line, and then even went out on a limb and said that they are starting to see a little improvement in demand. And that's a little different than what we heard out of Broadcom. So that is giving a big lift to a lot of semiconductor names. NVIDIA, you can see also breaking above highs. And now it seems like these two are beginning an uptrend, and that would certainly help the semiconductor group because these are two big names that have been lagging for quite a while. And then finally, General Mills came out with their earnings report. They did come in and beat on their bottom line, but they missed on their top line. So revenues came up a bit short. The stock gapped down earlier. It did hold that late May low, though, and has bounced back. Seems to just be in a trading range, but is down 4.3% today nonetheless. All right, Aaron, it is Wednesday. It's hump day. We're in the middle of the week. Got the G20 summit coming up. Market's a little nervous. That volatility index has been up now about 4 or 5 days in a row. I don't want to see the market break down here with the volatility rising.
No, that's exactly right. But, the good thing is when we do see that VIX start to rise and get what I call overbought, we can start looking for maybe a short-term move to the upside if we continue to see the VIX moving higher. It's hard to say, though, with the trade negotiations. There's all kinds of rumors flying. So I can see the market being a little tentative. But, wow, certainly the Nasdaq having a fabulous day with Micron.
Yeah, and the volatility index did peak back above the 23 level back in early May. And since then, we have been seeing lower lows and lower highs. So even though we are moving up this week, the overall downtrend, I would say, in the intermediate term has been lower, and that favors equities going higher. Mm-hmm. But anytime it starts moving up on a short-term basis, I get a little nervous. 17, I think, is going to be a big level on the VIX. Right now, we're at 1621. But since we fell at the beginning of June when the market, started to take back off to the upside, the VIX fell, and we haven't seen a close back up above 17 since then. So that might be a level we want to keep an eye on.
Absolutely.
All right, what do we got today?
All right. Well, we've got Bruce Fraser coming in tomorrow on July 3rd. Yay, we premiere the Chartwise Women Show. Me and Mary Ellen will be doing that. Hope you tune in for our first show. July 4th, of course, no Market Watchers. There's no market trading that day. Tony Dwyer will be with us July 10th, and John Murphy will be back on July 11th. And then later in July, we're going to be doing what we're going to call Relative Strength Week. So we'll be theming the entire week around relative strength. Today, we'll be covering, right after technical news and headlines, Tom, you're going to be doing July seasonality. On the 10 and 10, it's HEES for our first symbol. We'll finish off with sector rotation and the scooter report. Brian Shannon was not able to make it in today, so that is why we have moved the seasonality report to today. All right, technical news and headlines. Let's get it going.
Yeah, there were a couple of economic reports out, as you can see on your screen there. May durable goods came in weaker than expected, but when we strip out the transports, the May durable goods actually were a little bit better than expected. Keep in mind, durable goods tend to be extremely volatile. The consensus estimate on durable goods, and I'm kind of thinking about this off the top of my head, so don't hold me to this, but I believe it was a slight negative to a positive 4%, or maybe it was a minus 4% to a slight positive. But my point is, it's really hard to get analysts to agree on where durable goods are going. So we can see big hits, big misses from month to month. I would tend to look at this more over a period of time, maybe 4 to 6 months, to get a better feel for which direction durable goods are heading. May wholesale inventories came out at 10 a.m., just matched expectations. And the 10-year Treasury yield, as a result here, is bouncing a little bit today. And I pulled up this chart because I wanted to highlight something that I think is really important when you think about the rotation between different asset classes. So, we can always have new money rotate, or new money coming in to the Treasury market or into the equity market. But another big factor as to, how the market works is which way the money is rotating. Is it rotating from the more defensive treasuries, or is it rotating into the more aggressive equities? And so I highlighted a period here. Overall, you can see the 10-year Treasury yield's been going down for the last, 8-9 months. And during this period, we've seen the equity market move down and move back up. But when the 10-year Treasury yield is going down, that means money is moving into treasuries. Treasury prices are going up. But it doesn't always have to mean money is coming from equities. As you can see here, I think the correlation was pretty clear. Money came out of equities, it went into treasuries, and that sent the yield lower. But there have also been some periods where we have seen the 10-year Treasury yield move down, signaling money moving into treasuries, and yet the S&P goes higher. Well, if it was a perfect world and no new money came into the market, then I would say anytime you saw the yield going down, you would probably see the S&P 500 going down as well, because money comes money goes into treasuries, driving treasury prices higher, and it comes out of the equity market, sending the S&P lower, which would correspond with that decline in the 10-year Treasury yield. The reason I'm mentioning all this is if we get a bounce in the 10-year Treasury yield, normally what will happen is equities go higher. There's a much stronger correlation when the 10-year Treasury yield is going up, money is coming out of treasuries, and normally the reason money comes out of treasuries is because money is rotating into the equity market. So look at that little brief pop back at the beginning of January and look at the S&P take a big move to the upside. Same thing late March, early April, 3-week period to the upside, only went to the 50-day moving average. It wasn't a huge move. But look at the S&P 500 as a result. We saw a move of probably 3% in that 3-week period. We are way oversold on the yield. I don't think it would be, you'd still have a big downtrend in play if we were to jump on the 10-year Treasury yield up to 220, 230, something like that. I think if that were to occur, I think the S&P 500 could hit 3,000 in July as we head into earnings season. So this is one thing I'm going to be watching very closely. We got a little bit of a reversal today. I know I've been talking about, Treasury yields potentially bouncing. There's no guarantee. Maybe they just keep going lower. But if they do bounce, I think it'll be a catalyst for the S&P 500 to make this break and to make a run at its first close above 3,000 in its history. All right, as far as earnings go, we did have some earnings reports out. A couple of them I mentioned. Well, one I mentioned in particular was Micron. Micron came out with a very strong report. You can see the bottom line well ahead of estimates. So maybe, just maybe, a lot of the negativity has been built in to many of these semiconductor stocks. That's the way they're acting to me today. We'll see whether or not we can sustain this move into the close. Looking at a couple of these earnings reports on the charts, first one I wanted to take a look at was Fedex. Fedex has been under a lot of pressure. You can see the stock has been moving lower. We had a double bottom. We haven't broken down, but we also haven't cleared this intermediate high between these two lows. So I think that FedEx right now is still under a lot of pressure. They came out with their earnings. They missed on their revenues. They did beat on the bottom line, 501 versus 481, but they guided their fiscal year 20 earnings per share lower. Good news is they came out with lowered guidance, and they still are up today. So again, maybe the worst is built in. I would be very careful, though, if 150 is lost, because when you look at Fedex, it is one of the worst performers in its industry group, and its industry group is one of the worst performers relative to the S&P. So if I see a price breakdown with that kind of a setup, I would definitely want to be out. So be careful with Fedex. Next up is Micron. Micron, as I mentioned, beat on the top line, beat on the bottom line, and then it was just a little something, a little positive, but they said there are early signs of improving demand. And you can see the volume very, very heavy today on Micron as it tries to get through its 50-day moving average. I think this is a key price resistance area as well. So if I draw a price support resistance line there, that was the low. After we moved up back in February, we pulled back. We held this 37 area in March. Couldn't get through the top up here. And then when we came back down, we lost that 37 level. And now here we are testing both that and the 50-day moving average. So I think technically with this kind of volume, if we could get a close over 37, that would be bullish here. All right. Next up, I wanted to mention SNX because this is a stock that really looks good after its earnings report. I think first off, it held a key support area. So if I pull up again that price support, look at the low that was established back here after the earnings in January, kept moving higher, came back down, tested this low, held, and now with earnings and volume picking up, we're moving back up above here. It is in the computer hardware space. This is a stock that relative to the space was not doing very well, but this could be a game changer with the heavy volume coming in and the move through the 50 days. So this is one I'd keep on my radar. Last one I wanted to mention was General Mills. So let's take a look at General Mills. General Mills did miss on their top line. They came in $4.16 billion. Wrong symbol. They came in at $4.16 billion. The market was expecting $4.24, but they did beat on their bottom line, 83 cents versus 76 cents. Again, here was a gap up on heavy volume in March, and that level has been holding. I would watch 47.5 pretty closely on General Mills. I think that level needs to hold. If it does, we do have higher highs that have been going in. So as long as that low holds, I would suspect maybe the next move to the upside will be higher. For now, though, I would just treat General Mills as though it's in a consolidation trading range. All right, we're going to move into the scooter mover of the day. And today's scooter mover from the small cap area is MGI, MoneyGram. And you can see this huge gap up. MoneyGram actually came out with some news about a week ago that Ripple, which is a blockchain technology company, was investing 10% in MoneyGram at $4.10 for $30 million. Now, when they came out with the announcement, the stock was trading at $1.45, and they said, okay, we're going to put $30 million in at $4.10. That's why you saw this huge move and the massive volume. Stock came all the way back down, hit its 20-day moving average, now up 16%, starting to make another push to the upside. So not only is this a huge scooter mover, which is an exclusive feature here at StockCharts.com, but it does help to alert us to some stocks that technically might be making some rather important moves. And I think this bounce off the 20-day moving average, knowing that a company is putting that kind of an investment in at $4.10, I'm not surprised we're getting a bounce here. So that is your scooter mover of the day.
All right, time for some upgrades and downgrades. We're going to go ahead and we'll start with ConocoPhillips, COP. Mizuho upgraded it today from a neutral to a buy. Let's look at the declining tops trend line that has now been broken. Make some pretty colors here. So I'm watching this declining tops trend line, and we're not quite there if you're looking at it in the longer term. If you want to take it to a shorter term, we can draw right through here. And then you can see in the shorter term, we definitely have a breakout going on, but this will be the next area to watch, that 200-day EMA, and of course that declining tops trend line. We'll see if we can't get out of there. I think one of the interesting things that I'm seeing on this chart that gives me some good feeling would be let's get that right there. I need it right here. The PMO buy signal that just came in, very much liking that. And then if you look at the OBV, we're still looking at a nice move on the rising bottoms. We actually had, if you look here, a positive divergence on the OBV. So that right there tells you that we should expect something great. We did end up getting that rally. And like I said, we've gotten above that declining tops trend line in the short term. Okay, WDC. Western Digital was upgraded today. And on that upgrade, you can see that we got quite the move. Let's bring this down here. And you can see we earlier had broken this declining tops trend line. So we'd been in not a good spot here as far as the declining trend, but you can see now we've managed to break out here. We've got a PMO buy signal, and look at the OBV really supporting this move to the upside. You can just see that visually with all the green bars for volume. All right, next one up is WMB, Williams Companies. This one was upgraded today from an outperform to a strong buy. They have moved the price target up to, let's see, $32. So let's take this back here a little bit, and then I'm going to draw my horizontal line here. And let's get the crosshair. So $32 would be up here, just a bit higher. All right, so yeah, we can even, they've got it moving even higher than that. So we're looking right about here at $32. So they're certainly looking for it to move past these two tops we saw back here in 2018 in the first part. So I like the look of this. I would be looking for a move to the upside. You can see that if we bring it back out, you can see the PMO is on a buy signal. It's struggling a little sideways, but you know, look at what we've had here. We had, excuse me, quite a declining trend, but the PMO really didn't suffer too much. And now we're seeing the reading moving into positive territory. So that's a good thing to look for too. All right, let's move to some downgrades. ITW, North Coast downgraded today from a neutral to a sell. There was no price target listed. But let's go ahead and make our own targets here. So there is your upside resistance in the intermediate term, I would say, right around 158.81, as you can see there. I see the possibility of a flag here. You know, I think you'd be... there we go. Let's mark that. I think that it could be considered a flag or a pennant here coming in on this symmetrical triangle. Symmetrical triangles are generally continuation patterns. And so we should expect that breakout to the upside. You can see right now it is below the 20-day EMA as far as trading is concerned, but we do have a PMO that's moved into positive territory. And I think that is pretty good. So, you know, even on this downgrade, I'm not seeing the kind of deterioration for the intermediate term that maybe they're seeing. I don't know. KMI, Kinder Morgan, was downgraded by Raymond James from an outperform to a market perform. There were no targets listed there. So let's go ahead and we'll look at our rising trends here. And I suspect we're looking at a very similar, let's see. I'm going to bring that one down just a hair. Okay, so you can see we're in a rising trend, and but we've got a double top here working on this rise off of that. Let's get a little bit more focused here. There we go. So you can see we came down and have tested this. We had that rising bottoms trend line. What I'm worried about right now is the possibility of right here, a double top. So let's bring him over here. There we go. All right, so there's the one top, and then you've got the other top coming in right about here. So it looks like I need to get my ellipse going here. we go. And there's that double top. The confirmation line, of course, would be over here at the bottom part of that M. So it's not actually a double top until, of course, we get that breakdown. Given the downgrade, Raymond James certainly thinks it will break down out of this rising trend. And the PMO is not looking too good right now. Still working right here with above its signal line, but you can tell it's really trying to come down and test it. So I could go along with that downgrade. Next one, UBS downgraded State Street from a buy to a neutral, and they moved their target to $58. So let's see if we can get that in here. All right, so we want to move this one to 58, right about here. So they're really, they moved it to a neutral, so it's not like, horrible. It looks like we're going to be in a trading range, and I think that's what their target of 58 is really telling us here. And that's all I have for the upgrades and downgrades. Here is the list that I just went over. I'll have it in the MarketWatchers live recap at the end of the day. All right, what does seasonality look like for July? Well, Tom's going to tell you right after this.
I think StockCharts is a fantastic platform, especially the fact that it's web-based. So on the car on the way here from the airport, I was bringing up my cell phone and I was looking up really beautiful charts to get a read on what happened. I looked at the market summary page, and then I'm drilling into individual charts.
StockCharts is unique in that you've got all of the perspectives of many of the technicians.
A sincere desire to really help educate investors, and that's really critical.
StockCharts is unique because we combine the commentary, the education, as well as the tools in which you need in order to analyze the markets.
Okay, welcome back everybody, and we are going to take a look at July seasonality. First, there's a chart up here, the S&P 500. I just wanted you to kind of zero in technically as we approach July. We had the high about 29.40 back in September of last year. We got up just above 29.50 to open May, and now just recently, late last week, we got up above that 29.50 level. False breakout though, and came back down. So clearly, this 29.40, 29.50, maybe 29.55 or so. This is going to be an area to watch. If we can make the breakout technically, then I think we could be looking at some seasonality patterns that I think could help in our trading. So, and I really want to reiterate that I don't use seasonality as my number one go-to to place trades. I use seasonality to confirm what I am seeing technically on charts. So if there is a stock that I really like from a seasonality perspective in July, and the stock makes a breakout and we see volume coming in, that is a stock that I'm going to be even more interested in because seasonality confirms the technical showing up on the chart. So what I want to do though, before we get into this, take a look at this S&P 500 chart, and I'm just going to give you some stats on the S&P 500 since 1950 as it pertains to July. Since 1950, July has gone up 39 times and down 30 times. So in other words, S&P 500 tends to move higher in the month of July. The average annualized return for July on the S&P since 1950, 12.82%. That is higher than the S&P 500's annual return of 9% that it enjoys, average annual return over those years. So July actually on the S&P 500 over the long term has actually been a better month overall than the norm, than the average. That's not the case though with the Nasdaq and the Russell 2000. I'll get into those in just a minute, but the breakdown on the S&P 500, if we break it down from a calendar perspective, and another way, if you wanted to look at this, you could go into my article today in Trading Places, and down under historical tendencies, I broke it down for you. So here you can see July 1st to the 17th, 24.7% annualized return. So the first 2.5 weeks within the month tend to be very bullish, almost 3 times that normal 9% return. July 18th to the 24th, this is the second worst calendar week of the year historically, going back to 1950. So there's only one other week that has been worse. That is in October. And of course, that probably brings back a lot of memories. But July 18th to the 24th, that is a full 27 points, almost 28 percentage points below that normal plus 9%. So that is worthwhile noting as we get later into the month of July. If the market starts looking a little toppy, we see negative divergences, start to form around that time of the month. Just keep in mind that would not be unusual for the market to have a rough week right around there. Once we get past the 24th, though, we tend to finish July off pretty strong. 25th to the 31st, averages going up 19.12%. So that is the S&P 500. Now I'm going to go into the Nasdaq. So let's take a look at what the Nasdaq chart is telling us. And the Nasdaq is not back up near that April, early May high. We didn't quite get there, so we're seeing a little bit of underperformance. However, we are bouncing off the rising 20-day moving average. PPO has moved back into positive territory. If we take a look at a longer-term weekly chart, we are above that 20-week moving average, which I think is very important. I could argue that we had off of an uptrend, maybe a little bit of a cup, although it's not very rounded, with a pullback, nice reversing candle. That could be a handle. And now the volume has been picking back up again as we make another push for these other highs. Watch that breakout. I think a breakout there clearly to all-time highs would be extremely bullish if we get that on the NASDAQ. As far as seasonality, since 1971, the NASDAQ has gone up during the month of July. We've ended the month higher than we began it 26 times. We finished lower than we began it 22 times. So a little bit of outperformance there. The average return on the NASDAQ, the annualized return for the month of July, 5.38%. That ranks 10th among the 12 calendar months in terms of NASDAQ performance. So July is not as good on the NASDAQ historically as it tends to be on the S&P 500. And then finally on the Russell 2000, we'll pull up that longer term chart on the Russell 2000. You can see the relative strength just has not been there. We've talked a lot about that here on the show. I'm not going to spend any more time right now. But the Russell 2000 since 1987, we've seen it go higher in July 16 times and lower 15 times. The annualized return, minus 2.84%. It ranks 11th of the 12 calendar months, with only September being worse for small cap stocks. So that's kind of an overview looking at the major indices. I've also given you that breakdown on the S&P. That breakdown tends to be pretty similar for the NASDAQ and Russell 2000, so I won't go into those numbers. So what areas of the market, what sectors tend to perform well in the month of July? Well, one way you can do this is go up here and you type in the seasonality. You can type in all the sectors, but let's start with financials. And you can see over the last 5 years, financials have been up every year in July, averaging 3.4%. I tend to like to get a longer term perspective, but you can see roughly 2/3 of the time, July moves higher and it's up 1.7% on average. And if you want to compare that to the S&P 500, you just simply type it in the box and we go back 20 years and you can see July tends to be a pretty good month for financials. So note that we talked earlier about the 10-year Treasury yield moving higher. If the 10-year Treasury yield moves higher and the S&P 500 breaks out, there's a very good chance we're going to see leadership from the financial group. Number one, they tend to perform better than the S&P when yields are moving higher. And then if you look seasonality-wise, they tend to just perform better in July for whatever reason. The average return of the XLF versus the S&P 500, the average outperformance is almost 1% in the month of July over the last 20 years. That's a pretty significant number and trails only April in terms of better relative performance for the financial group. So financials, from a seasonality perspective, this is a group I think we want to pay some attention to. Healthcare. Today's having a little bit of a rough day, but overall, if we go back the last 20 years, you can see that the June period tends to be an outperforming time for healthcare, and that extends into July and August. Slight outperformance here. So these are two areas. I would say financials clearly are stronger, especially in July, but both of these areas I think do tend to outperform in these summer months and are worth keeping an eye on. The other thing I wanted to show you is that if we go back and look at the last 12 years, look at June. June has outperformed, the healthcare has outperformed the S&P 500 every year going back those last 12 years. It's a pretty impressive stat. Just thought I'd share that for you. Okay, how about lagging? What areas tend to lag? Well, one area that tends to lag is energy. And I think this is important because crude oil, as I mentioned earlier, getting up to $60 a barrel, this has been in a level where we've seen crude oil pivot back and forth. So when we're coming down from above 60, we've seen bounces. When we're underneath 60 and we get up to that level, we've seen retreats. So when I look at this and I see energy historically has underperformed the S&P 500, and when you look at it, that's the worst relative strength on energy of any month during the year. So if crude oil, if you see it reverse at $60, start moving back down, this would kind of line up with history in that energy does tend to underperform in the month of July. Another group that also tends to underperform is utilities. So when we look back at utilities over the last 20 years, July, you can see that average underperformance, minus 1%. Once again, the worst month of the year for utilities in terms of relative strength. And then let's pull up the materials. Now, materials, when you look back over the last 20 years, you can see there's actually a little bit of outperformance. But if we think about the years when the dollar has been strong, which has been the last 8 or 9 years, let's just go back and show you what's going on the last 9 years. The last 9 years, materials have outperformed the S&P 500 only 25% of the time. And you can see the average underperformance of minus 1.3% trails only September's minus 1.6%. So the dollar's been weak here over the last, week or 2 weeks here in June. But if the dollar begins to bounce again, just keep in mind, historically, materials don't do well during the summer months. So 3%, if you break this down by quarterly performance, relative performance, materials outperform in the fourth quarter by, 1.4%, adding those three across. In the first quarter, they underperform by about 1%. In the second quarter, they're about flat. And in that third quarter, July through September, minus 3%. So this does tend to be, the summer months tend to be wicked for the materials group. All right, how about industry groups? Well, we talked about the financials, so I can't leave off the banks. Because again, if the treasury yield does move higher here, we want to pay attention to over the last 20 years, July has been the best month, the most reliable month in terms of outperformance by banks. 63% of July's, which is higher than any of the other months, we've seen the bank index outperform the S&P. And look at the relative strength, 1.6%, more than double any other month. So treasury yields bounce, the S&P 500 breaks out, financials do well, expect banks to be leaders. And we'll take a look at some individual banks in just a little bit that look pretty good seasonally. And a couple of them, I think, that look pretty good from a relative perspective, actually are outperforming. So if we do see money rotate into that group, I would expect those stocks to lead. Another area, and I've mentioned this many times, in the healthcare space, biotechs. Biotechs love the month of July. I would absolutely have some kind of exposure to biotechs, even though the group hasn't been that strong. We're starting to see strength in the group, and just knowing what we know about the seasonality here, I suspect we're going to see it continue. The relative strength on biotechs begins to pick up in May, accelerates in June, and tops in July. May, June, and July average outperforming the S&P 500 by more than 6%. No other 3-month period is even close to that. So we are starting to get into the sweet spot for biotechs. You want to make sure you keep that in mind. If you're looking at individual biotechs, I would look obviously at relative strength. That's still going to be my number one go-to. But I also want to look at seasonality, because if you can get both of these lining up, I'm going to feel much more confident about that trade. All right, what does not perform well? Well, something that's been performing really well, which are the precious metals, mining stocks. If we go back over the last 20 years, July has underperformed. Mining stocks have underperformed the S&P 500 on average by 3.1%, by far the worst month of the year in terms of relative performance in July. And if we bring up the gold mining index, the precious metals, you can see if we drag this back, again, July only going up 37% of the time, only outperforming the S&P 500 37% of the time. And you can see that minus 2.4%, very significant underperformance on average, topped only by March and October. So those are some areas that typically don't do well. And again, what we're looking for is if the 10-year Treasury yield starts to rise, I think that could, in the short term, end the dollar weakness. So if the dollar weakness ends and we start to turn higher, that could be the catalyst where we see gold struggle. I've talked about gold. I know that gold's broken out short term. I think that's great. I would watch the rising 20-day moving average. If we start losing that, I don't have long-term confidence in gold. I have only short-term confidence. Knowing the history here, knowing that seasonality plays a negative part for gold, I would be looking at any breakdown on the chart as a pretty significant breakdown. Also watch gold relative to the S&P, because even though it has been strong throughout this move to the upside, it really, on a relative basis, hasn't been that great. Keep that in mind. All right, a few Dow stocks that I would maybe keep in mind as you look at the seasonality. The first I'm going to bring up is Caterpillar. And while I'm talking about Caterpillar, I want you to take a look at that poll, because we're going to be bringing that up in about 10, 15 minutes. And that is pointing out 6 stocks that tend to perform really well in July. And I just, given that backdrop, which of those 6 stocks would you feel most comfortable buying today and holding through the end of July? So that should take into account not only the seasonality, but also what you're seeing on the charts. That's what we'll take a look at the end of this segment. But July, you can see up 58% of the time, Caterpillar, but look at the average return, 4.2%. That trails only April and November. So July tends to be a pretty good month for Caterpillar. Cisco, not a lot of strength here, but still there is strength. And so let's go back 20 years and you will see that July and September, 2 bearish, not great months for overall for the market. These 2 months have been the best 2 months in terms of predictor for Cisco going higher. Best 2 calendar months. Now the returns are not necessarily great. You can see September, clearly we had some bad months. Those months where we were down probably were some really bad months. But July has averaged going up 2.2%. And that rivals months like October and November, where we typically see a lot of bullishness in technology stocks. So I thought the July number there was pretty interesting for Cisco. Goldman Sachs talked about financials. Look at this. Look at these numbers here. Look at Cisco going back, or Goldman Sachs, going back the last 12 years. 11 of the last 12 years have been higher. Goldman Sachs averages going up 5.8% during the month. Now, as we stretch it out, comes back down some, but still, July, very strong over the last 2 decades on Goldman Sachs. IBM. All right, IBM. Now, if you go back the last 16 years, actually, we'll go all the way back. You can see July's been one of the best months for IBM. So while IBM's not one of my favorite stocks out there, July looks pretty good for it. And then the last one I have on the Dow is another bank stock, JP Morgan. You can see over the last 5 years, JP Morgan has been up every year in July. If we go back the last 20, it is gone up more in July than any other month. And the average return of 2.6% actually compares pretty favorably to the other months. Maybe March and April, they're a little stronger, but JP Morgan tends to do pretty well. All right, how about the Nasdaq 100? How about some stocks in the Nasdaq 100 that you might want to consider? Well, I mentioned healthcare earlier, and Align Technology tends to have a pretty good history as we go into these summer months, especially July. So if I go back just the last 10 years, you can see July is averaged going up 6% per year, which is the best month of the year. So if you go all the way back 19 years, that prior decade, it wasn't as strong. But Align Technologies has been a big performer in the market for the last decade, and you can see that that performance in July has been strong. Let's go through a couple of these. Celgene in that biotech space. Last 5 years, up every year, up 11.2% on average. Go back 20 years, it's gone up 80% of the time and up 8% on average during the month of July. Right, how about Expedia? Expedia up every year in the last 5 years, averaging 9.3%. Going back 15 years, it's been up 80% of the time in July, averaging 6.4% during the month, which trails only April's 7.8% average gain. Google likes July. Last 5 years, been up every year, averaging 11% return. If we go out the last 16 years, it's gone up roughly 2/3 of July's, and average is going up 4.6% during the month, which really only trails September and October in terms of average monthly return. So Google may be poised, at least from a seasonal perspective, to maybe make a run. Now, sometimes I'm going to go ahead and pull up Autodesk here as a company that really doesn't like July too much when we go back the last 20 years. It's only gone up 32% of the time, and averages going down 1.6%. But then all of a sudden, that we go into the last 5 months of the year, and you start to see some pretty good outperformance, especially in August for Autodesk. And then Advanced Micro Devices. This is a good one that will cater to your bias. So if you're bullish AMD and I'm bullish, I would look at it and say, wow, last 5 years, it's been up most of the time, averaging 11.3%. That's pretty good. But if we go back 20 years, AMD has only gone up 37% of the time, and July has been its worst month. So, Dave Keller talks about these biases that we have. If you're bullish AMD, you're going to say, well, look at the last, handful of years. AMD loves the month of July. If you think it's run too much and you think it's bearish, you would point to the 20-year performance, which has been very negative. All right, as far as some individual stocks within the banks and biotech sector, one I'm going to focus on is ALLY. And I'm going to focus on this because I want to bring up the price chart on it as well. And what you're going to see is a stock that not only has been performing well, but it's trying to break out. Look at the relative strength on this stock versus the bank index. So this is one of the strongest performers. It's trying to make a breakout. And when we look at seasonality, last 5 years, now this one hasn't been out for very long, but the last 5 years, it has gone up every year in July. And I think we can go back one more year. It did go down that year. But even over the last 6 months or 6 years, you can see that ALLY does favor the month of July. It's making a breakout, and it's a relative leader. So, when you think banks, you might think Citigroup, JP Morgan, some of the big names, but there may be some others, some middle to smaller cap names that might be even better as an investment as we go into the month of July. This is one I would certainly give some consideration to. How about HDB? Going back the last 19 years, July's gone up 2 out of 3 years. Average is going up 3.9%. And again, that only trails March and April's average returns. And HDB, if we look at it on a relative chart, It has been going up and clearly is a relative outperformer. So 20-day tests have been a pretty good entry point in the stock. And just imagine money beginning to rotate into banks, what the stock might do. I think that these are the types of stocks that I would be interested in. Citigroup, mentioned Citigroup. Here's the chart. Right now it's kind of bouncing off that 20-day moving average. And seasonally, last 5 years, you can see it's gone up every year, averaging 4.9%. We could even stretch this back the last 7 years. And you can see the last 7 years up every year in July, averaging 5.3%, best month of the year. Looking back longer term, still goes up 2/3 of the time, averages 2%. But this is one that certainly in the last handful of years has shown some nice relative strength. IBN. Last 20 years, IBN's gone up 2/3 of the time in July, 2/3 of July's, averaging 2.3%. And if we look at the chart, stock making a breakout, trying to make a breakout, look at the relative strength. Right now, just about a 52-week high relative to the banking index. So banks have been going down mostly. Some of these stocks, even with money rotating out of banks, some of these banks are still doing pretty well. And these are stocks that, again, on a relative basis, are going to be very strong and would be ones that I would be focusing on. All right, let's turn our attention to some biotechs. I mentioned Celgene, probably mentioned a couple of others, but I want to look at INCY. This is Insight. And when we go back the last 20 years, only 53%, 2.3%. But look at the strength continue into August. So I do think as the weather gets warmer, Insight tends to perform much better. Looking at it on a chart, you can see the stock just got up to this recent high, is pulling back in on lighter volume. I think that 82.5 up to 85 is an interesting area to accumulate on a pullback. I think that we are sideways consolidating after an uptrend. And given the overall strength in the group that we tend to see in July, and the fact that we have a stock that is breaking out on a relative basis and on volume, that tells me Insight is poised for a push to the upside. Illumina. Talked about Illumina quite a bit. Look at the last 5 years. That July performance sticking out pretty strongly, but go back 20 years, not so much. So let's just talk about the last decade or so. Actually, probably the last 8 years. You can see 7 out of 8 years higher. 4.9% average return. And Illumina looking pretty good technically, barely even budging to the downside. Even when the group is pulled back, look at the relative strength. It is holding up while the group is selling off. That tells me if the money rotates back into the group, we are probably going to see continuing strength in Illumina. Amgen. This is a big name for those of you who like to trade or own some of the bigger names. 20 years, 84% of the time Amgen goes up in July and averages 8.7%. I mean, when you look across here to every other month, this is one of the more startling seasonal charts I've seen. That alone would have me looking at Amgen quite a bit in terms of their technical outlook. And if we look at Amgen right now, we have started to make a boot move on volume. If we get a pullback back down the low 180s, given what we just looked at in terms of seasonality, I think Amgen would be a great reward to risk trade. All right, I'm going to pull up one more, and then we're going to get into the poll. Let's take a look at Alexion Pharmaceuticals, ALXN. Last 5 years, up every year, averaging almost 10%. And last 20 years, July's been the best month, averaging 6.7%. Again, pulling up the chart, we can see not only did we make the break above the 20, but we are actually testing that 20-day moving average right now. I think this is an incredibly volatile stock, as are many stocks in the biotech space. But I think this is a solid reward to risk entry. If you just wanted to trade it, expecting that 20-day moving average to hold, you've got maybe about 6% upside and perhaps 1% downside. I'd probably have a stop below today's low. If it went back down below, say, 123, I might reconsider and just take a 1% loss. But if it does hold on the 20-day and we start to see that strength in biotechs pick up, I think Alexion is one that certainly could make a pretty big push to the upside. So that is the seasonality report for July. These are that's a summary of the different things that I just covered. You might want to just note some of those stocks. For the most part, I wouldn't rush out and just buy them based on seasonality. I think that you want to see the charts setting up as well. Now, as far as that poll goes, and I don't know, Aaron, if you had a chance to take a look at it, but
yes, indeed.
What did you think?
Well, I pulled up a candle glance, and for me, I can see Amgen and Illumina, but I actually went with Ally. I like the look of that chart better than the other two, so that was the one I went with, was Ally.
Wow. That kind of, we align on that one.
Really? Oh my gosh, we need to mark the calendar.
Yeah, I'm not sure what that means. Is it a guaranteed lock that it's going higher, or should you run for the hills?
I know. Well, we'll find out, won't we?
Yeah, I like that one because on a relative strength basis, I was showing that has been a really good performer relative to the banks, and it is threatening to make a breakout today. So I'm not surprised. I would think your PPO or PMO, looks pretty good.
Yeah, it looked the best. I mean, Amgen, like I said, Illumina, they still looked pretty good, but they were kind of overbought, I believe.
Mm-hmm.
Yeah.
What about Caterpillar? I mean, Caterpillar's been down quite a bit. Got hit really hard again in May when the market turned down, but it's really come back pretty strong here of late. I mean, only 14% going with a very hot stock right now.
I think that would have been my second choice, and then Goldman probably after that.
Mm-hmm. Well, it's amazing, too, how our biases do affect us. I'm not at all surprised to see those financial stocks on the bottom because the financials haven't been doing very well. But seasonality tells us things could pick up. And if we do see a bounce in that 10-year Treasury yield, those are two that certainly could perform well. I mean, keep in mind, all 6 of these stocks do have strong seasonality in July, as I went over. But I guess it comes down to the technicals. And you and I both agree on Ally. I don't see anything in this list that I would not be interested in. Honestly, I would have them all on a watch list.
Oh, I absolutely agree. I think all of them are kind of lined up. Like I said, I just Amgen and Illumina kind of worried me that the PMOs were really overbought. I mean, that doesn't, say that it's going to go down next month, but I just like to, make my picks a little more, have more confidence in them.
Yeah. Yep. Okay. Well, the crowd has spoken. Amgen is the winner. Aaron and I have spoken. We're going with Ally. This would be a fun one to come back. Maybe market take some notes. But I think this would be a good one to come back to and see at the end of July, maybe.
Indeed. We'll have to do that. I like it when we go back and look at what we all said to see if we were on or off.
I prefer it when I'm right. I'm just.
Don't we both? Doesn't everyone?
Yeah, I know. But hey, you're going to be wrong sometimes. You just hope that you're right more than you're wrong. And then, as a good friend of mine used to say, you just hope you're not wrong for long. That's the key.
Right. And just, set your risk levels and understand and know them. That's kind of the big one, right?
Yes.
Okay, that's 10 and 10.
Yep.
I have got an RRG already. And technology, big one today. And healthcare was the other group, including somebody wanted to look at the healthcare sector spider, but we'll kind of cover that, I think, in sector rotation. So I'm not going to pick that one today, but here you go. Interesting. A lot of movement in all directions here. So we'll see what you think of these charts. And the first one is HEES, HEES.
Yeah, HEES is just going sideways. I looked at all the relative charts going sideways. The stock price is going sideways. So I just think I wouldn't trade it unless it was in a range. Now you could take it's been holding this rising 20-day moving average. So perhaps you might say, well, this is the time, because if it gets below the 20-day, I get out. If that's your strategy, I'm okay with that. But otherwise, we've just simply been in this sideways consolidation. If we lose the 20-day, I think we'll see another trip back to 24. So I'd keep a fairly tight stop here.
All right. And the most popular in the chat room today was NVCR, which is Novocure. And they asked, there was a breakout followed by a pullback to the 20-day, EMA, and a retest of the former highs. So do you think this is a good entry?
Yes, I do think this is a good entry. I think it's a perfect entry, actually. Love the breakout on increasing volume. We've pulled back to test price support and the 20-day moving average, which has been holding for the last 2 months. And look at these relative charts all lining up. I think this is a great call. I have no problems with this one. You probably could keep a stop below, say, 55 on a close, or maybe even a little bit higher. I was just looking at this bullish engulfing candle. You could even use the 20-day moving average, which is pretty close, less than 1%.
Indeed. Yeah, I have to say it broke down below that rising bottoms trend line, but I think it still has, I'd like to see my PMO turn up, but I still think, yeah, it looks pretty good. All right, next one up is T-Mobile.
All right. Yeah, this is one that I've been warning a little bit about, the group. The group is turned down on a relative basis versus the S&P 500, and that has worried me. So what I have been suggesting is that if you own stocks in this group, like T-Mobile, I don't want to lose price support. And I think that this is a pretty important area that it is threatening to lose today. It's been down 5 days in a row. I'd watch this one closely.
All right, next one up would be Grubhub. Symbol Grub. I love it.
We talked about this one a little bit on the show yesterday.
Mm-hmm.
Yeah, I like the fact that it's getting back up above the recent resistance area. So on the chart itself, I think this is a pretty big level, and we got above it. Look at the volume pickup as we move through it. The only thing I would say is that this has been a very strong area of the market, and this has been a very weak performer. So I'd keep a tight stop. Well, it's kind of hard to keep it too tight because it's made a big move here. But I would say a close back below 73, 74 would get me out. At the worst, the 20-day moving average. There's no reason at this point for the stock to go back below the 20-day. So watch that closely.
All right, let's see if you agree with me on this one. Huntington Bank shares, HBAN. PMO just went positive. Looks like we might be getting close to a short-term breakout. I've got a 20-50-day positive crossover. Do you like it?
No. Only because, I think the banks, like I said, we just talked about seasonality. I think the banks could do well. But the problem that I've seen is that, I want to go with stocks that are showing more relative strength. So I think we're just kind of, in this, I don't know how I want to draw, maybe draw it there. But I just think right now the stock is languishing. And when you look at it on a relative basis, it has started to pick up. But I think some of those others that we looked at were much stronger. So it's not that I don't like the stock. I'm neutral to stock. I don't really see anything worth trading here. You got trend line, you got overhead resistance coming up in 3 or 4% at that May high. So I just like others better. That's really my answer.
Fair enough. All right, the next one is from the industrials, Select Energy Services, WTTR. All
right, I think we right now are just sideways consolidating. I mean, relative strength, not very good. So that probably would tell me just to leave it alone. But there was your breakout on heavy volume back in March. We finally did go all the way back down there and hit that level. This is the trading range. So I'm going to say 1060 to 1260. Let's see which way breaks first.
All right. Next one is U.S. Steel, and that, of course, is X. Enjoying the rally that all of the material stocks seem to be.
Yeah, this one is starting to look better. And I know they came out with a warning recently, and the stock just ignored it. Stock price kept going up. So I think that's a good sign that maybe all the selling had built in. and maybe we're seeing a change in character. Now, this is not in a good group, and it has not been a good performer. So the fact that it is holding this 20-day moving average, that's a good sign, but it is also where my stop would be. If this stock breaks back below the 20, given its longer term relative strength track record, I would be out of it. So I'm going to keep a tight stop.
All right, here is a software company, Mongo, MDB.
Yeah, Mongo has actually been a very, very solid software stock, and it's pulling back, and this is one I'm keeping an eye on. I actually like it pretty darn close to this level. I think we could get a 50-day test, but there is your price support test, which we are getting today. Anything down around 150 as it gets close to that 50-day moving average, I'm going to be very interested looking for a rebound. The stock's gotten hit a little bit here over the last week, like many software stocks, but the volume's been lighter. I think there's accumulation taking place. I think this has been one of the stronger stocks within the group. So I like it. I'd use this weakness to buy.
All right. What do you think of Infosys? It looks like something you might like. FY.
Yeah, one of the earlier stocks to come out with earnings. You can see here, they'll be one of the first to report when earnings kick off with a number of the big banks. So I do like the pullback to the 20-day moving average. The relative strength on the stock is a little suspect. It's been going down for the last 5 months, and you can see a lot of volume on some of the selling. So I think what I would do is just keep a tight stop. I'm okay with it, but if we lose that rising 20-day moving average, we have been holding it for the last several weeks. So if we were to lose that, I'd probably be out of it, just given the relative weakness. I don't want to lose a key technical level. So that's maybe what I'd be focused on right here.
Okay, and our last one, full disclosure, I own it and I'm going to continue to hold it for now. Southern Company, SO.
Okay, yeah, it's been a great performer. Nice volume trends, relative strength, all looks good. So for me, and actually the group has just been kind of so-so, not bad, but this has been one of the leading stocks within the group, which is what you want. Always. I always want to get relative outperformers. I like the volume here. Really not a whole lot bad to say. I mean, this is a little bit of a defensive play as well. And in the short term, maybe would watch a couple of support levels. I think the first one would be right down here around 54.25. And then I think you'd maybe use a line in the sand around 53. If you broke that level, probably be looking at relative weakness. You'd see the 50-day being lost, price support that's already been tested here being lost. So that's maybe 53 would be my line in the sand. But otherwise, I think this one looks good.
All right, that does complete the 10 and 10. Here are the symbols that Tom just annotated. You'll find those in the MarketWatchers Live chart list. Just go to the Articles tab, click on the MarketWatchers Live blog, and the link will be right there on the top. I'll be right back with the final market update after this. And now it is time for our final market update. Markets having a pretty good day, I have to say. Nasdaq certainly is the leader with a big gap up. It is sort of kind of digesting that move, moving sideways, but we're seeing rising trends on the NYSE as well as the Dow. And, Russell 2000 not really following that path. It continues in its downward slide, really waiting for small caps to wake up. And today they really haven't quite done that yet, mostly unchanged. TSX is lower on the day, currently down 0.25%. Treasury yields are rising. We're looking at 2.038% right now. Volatility index has fallen just a wee bit. It is just over 16. We could see UUP, started up positive, but has been pulling back. Looks like it might have found its intraday low because it is starting its way back up, but currently down 0.09%. GLD currently at 133.27, lower on the day by 93 cents. USO having a great day, not a surprise. I bet they are the reason we're seeing energy looking so good today. Big gap up and now digesting that big move. Currently up 2.63% for USO. TLT is lower on the day by 67 cents. Appears to have found some support here intraday. And it doesn't look too bad. Hopefully we'll be able to hold that level. You can see that it was support on Monday. So we'll be watching that closely. As far as our sector summary goes, as I said, energy is certainly the leader, up over 2% right now, followed by technology, likely due to the semiconductors all having a great day on Micron's great earnings news. Utilities, certainly the laggard here, down almost 1.5%.
All right, I was going to take a look at the Nasdaq here on an hourly chart because the Nasdaq was having a good day, but I don't think it looks very good here on the 60-minute chart because that initial push to the upside didn't last. We have been drifting back lower, and we failed at that declining 20-day when we've gotten that death cross on the hourly chart, which we had not seen throughout the entire month of June while we've been in this uptrend. So PPO's gone negative on the hourly chart. We're getting failures at the 20-day moving average. I would be watching this level right in here, about 78.40 to 7,900, pretty closely. We've got gap support just below 78.50. We got that prior high right around 7,900, which we closed below yesterday. So just with the failure, the short-term failure at that 20-day moving average, I would be watching the support area to the downside. I believe if we drop below that, we could see the volatility pick up and we could see a little bit more of an escalation in selling. So watch that level closely. All right, it is time now to move into one of our final segments. This is going to be sector rotation. So we're going to take a look at a little bit about what's been going on, how the money's been moving. And Erin, I know you've got some interesting charts for folks. What do you have for today?
All right. I thought today for sector rotation, I would give everybody a tour of how they can watch it and understand it. So this is our charts and tools page. Right here is where you'll get to that. And if you scroll down, there is a sector perf chart. So I'm going to start there today. All right, so for the last 200 days, this tells you which groups have been performing the best. It shouldn't be a surprise to see staples, utilities, and real estate on the upside. It has been, in the last 200 days, we've seen those defensive sectors outperforming. If you want to look, though, what's been happening, well, let's look at the last 50 days. There we go. And we still see the leadership for staples and utilities, but now healthcare has joined the bunch. And as you can see, the energy sector has suffered for a while. Look at this. Just watch that perf chart bar. It's just really been hurting for quite some time. So it's nice to see it picking up a little bit. This is the last 2 days. We're finally seeing some positive moves. Now, on this same sector perf chart page is our sector rotation model. And we have updated it. We've added comm services and real estate in there. And then here are the stages. And it tells you what you should expect given the stage you are in your economic cycle or in the business cycle. And so right now, I would be looking in this early recovery, full recovery. We've seen the flattening out right now of the yield curve. We're seeing the Fed not really rising rapidly as far as interest rates, but certainly starting to move to the top, which would be bottoming out. Flat industrials, we're not quite seeing that. We've been seeing the rise, and consumer expectation, I think it's continuing in the rising category, but moving maybe neutral in between. So this is a great way just to get a feel for what you want to look at and what should be doing well. And if things aren't doing well when you think they should be, this is where you can check to see where they would fit on the cycle. So for example, here are staples, utilities, healthcare, real estate. These are your typical defensive areas. And you can see based on the business cycle and the business cycle, and then also looking at price, the market cycle, it'll tell you what you should be expecting when you start seeing these groups leading. And as Tom, you've talked about it a lot of times, we tend to see market tops. And as we're coming down into that bear market arena, that's when you should start expecting these groups to do better. And I think that's what we've been seeing. So if you want to look at something other than the perf chart, which I think is great, we can also go, let's go back here. So that'll be same place. We have the sector summary. And this is the one I do for the market update. And, it's a great place to go. But Sometimes people forget we can use the period. This is telling us just what's going on today, but maybe I want to know what's been going on for the last week as far as rotation. And there you go. You know, the last week you saw on that perf chart, energy has been doing pretty bad, but was starting to show some move to the upside. And that really is represented right here on the sector summary. And the other thing you can do, if you'd like, is use the scooter, and you can check out how they rank amongst each other based on their scooter. And is it a surprise to see energy at the bottom? Not really. Technology at the top? Not really. So these are the kinds of things you can take a peek at, and it also gives you a feel for what's going on as far as the rotation of the money from one sector into the other. And then the other one I wanted to show you is the sector RRG. If you're on the sector summary, you can just come down right here and get to the other items. But I'm going to go to RRG first. And Julius has put this together. You can select various groups and members of some of these sectors. So it's not just the sector ETFs that you would see here. You can also look at it in terms of, well, somebody was interested in XLV, remember? So we'll look at the XLV RRG, kind of a mess right here, but it does give you an idea, just looking at the colors here, which ones are in what category and maybe which ones you might want to pay attention to. And here are a lot of healthcare providers in that improving category. And those are the ones I usually like to look at, or possibly in this red area and starting to make the turn. Or I know Julius talks a lot about when you get a hook back, you know, moves into weakening and then it'll hook back up into leading. So that's another thing you can look for on your relative rotation graphs. All right, let's go back to this RRG, and the link is down here, again, off of the sector summary. And then I also look at the candle glance, and here you go. This is what gives me a feel based on my candle glance style of which groups look the best to me right now. And, you know, energy is making that play right now to the upside. This might be a time for us to see some recovery here based on the PMO, although it's not positive. And I like the industrials right now, looking at just the candle glance PMO.
Okay, I am going to take a look at the different groups, different sectors, that is, relative to the S&P 500 on both a short-term and a longer-term basis. So in doing so, I'm going to start with kind of a big picture view. First, as you look at this chart, now the top of this chart is the S&P 500. This is 10 years. So this is essentially the entire bull market that we've been in since 2009, since that 2009 low. And beneath it are all of the aggressive groups in the market relative to the S&P 500. So it's not telling you whether they're going up or down. It's just simply telling you whether or not money is rotating into those sectors versus the S&P 500. One thing from a historical perspective that you want to see when the stock market is going higher is that money is rotating into the aggressive groups, which is technology, the XLK, consumer discretionary, XLY, communication services, XLC, industrials, XLI, and financials, XLF. Now, they don't all have to be going up simultaneously. In fact, that's really hard to do, because if those five are all going up relative to the S&P 500, then everything else would have to be literally cratering versus the S&P 500. That's not going to happen. And when you have a strong dollar like we've seen, that actually helps some of the more defensive groups, because money is rotating away from energy and materials. So some of the defensive groups get a little bit of a lift from that. There's a lot that goes into it. But what I wanted to point out is that as we sit here ready to break perhaps above 3,000 to a historic move on the S&P 500, look at how traders are viewing two of the key areas, technology and consumer discretionary. Yes, on a daily basis, maybe on a weekly basis, we'll see pullbacks on a relative basis. But I think it's hard to deny that these two groups have been leading on a relative basis to the upside. Communication services, a little bit more consolidation. XLI, after breaking out above this area around 0.0255, went all the way up here to 0.028, pulled back, tested that level, and I think is still holding up pretty well. Same with financials. After breaking above this period of sideways consolidation, we went down just beneath that relative price support, and if now turned back up, I'm looking for the downtrend lines, relative downtrend lines, to break here. But I think all 5 of these are still healthy in the long term, and that to me says secular bull market. So I believe we go higher. I think the S&P 500 is going to break out again in the second half. I actually am pretty bullish. I think the numbers could be a lot higher by the end of the year than a lot of people think. I wouldn't be surprised to see the S&P 500 well into the 3,000s by year end, based on what I'm seeing in sector rotation right now. Now, from a short-term perspective, I think we have to look at a couple things, and let me pull up the current 60-minute chart and show you defensive groups. Now, normally what happens is when the S&P 500 goes down, like we saw in May right here, normally that folks get very conservative, and that's when you start to see the outperformance in defensive groups, and that's what I have focused on down here: real estate, utilities, and consumer staples. And now, since we have been rallying in June, look at the relative performance of these defensive groups going back down again. And even with this week, with the market rolling back over, I'm actually seeing money rotate away from defense, which tells me that there's a pretty good chance this selling isn't going to last. And I think we're going to get a big breakout coming up. Now, whether or not we pull back a little bit further is hard to say, but I think if we get back through the 20-day moving average, based on everything I'm seeing on sector rotation, I believe we are going to go a lot higher. Here is our summary for this particular sector rotation segment. And now we're going to wrap it up with a scooter report. And what do you have for the scooter report, Aaron?
All right. Well, what I decided to do is to use my scan that I use that concentrates on the scooter. So I'll just show you that very quickly. And I did recently do a ChartWatchers article on that. So just go to the ChartWatchers blog and you can get all of the code if you wanted to set up your own. But mainly I wanted to, I look at, oops, that's the wrong scan. That's the right one. Normally I look at the PMO rising. With this particular one, I let the PMO be positive. And then I also make my scooter between 70 and 80, because I'm looking for something that's on the rise or has some relative strength, but has room to maybe run and move up into a higher scooter rank. So when I did that, I came up with a couple of names, and I'm going to look at Adobe first. There we are. So Adobe came up on my radar, and we did see the PMO kind of stall out here, but look at this huge decline, and the PMO really didn't turn down. And now we're seeing a little bit of a move back up here. It looks like this, what could have been an island, I think, is now, we're safely out of that. The 285 level would be support. And I would be looking for a move to challenge the top we saw here earlier. Well, it looks like last week. So I think Adobe still looks really good based on its scooter as well. You can see down here that scooter moved into that hot zone and is now starting to oscillate within it. So I like that. The other one was Garmin. I thought that looked good. And you can see the PMO, it's the same sort of idea. We had this pullback, but the PMO really wasn't damaged that much. And now it has moved into positive territory. You can see the scooter has been maintaining right around that 70, 75 range. I think that's healthy. And OBV has been rising. And note, we had that pullback and we made that new low back here, but it is still higher than the previous low by quite a bit. So I think the volume pattern looks pretty good on Garmin. Let's see, Gunner, which is the Global Upstream Natural Resources Index Fund. It's always interesting what comes up in these scans, stuff that I would probably never heard of or thought of, but look at 20-day, 50-day EMA crossover, holding above the 5-day EMA. PMO is not overbought at this point, and look at that the scooter moving right up into that hot zone. OBV, you've got a nice amount of volume that came in on that gap, and as we're starting to pause a little bit, the volume is starting to fall, but I think that is good for consolidation. Oracle was another one. And there you go. I'm seeing this symmetrical triangle right now. That is a continuation pattern, tells me to expect a breakout to the upside. PMO, very happy on that gap up. And, you know, OBV, okay, I'll give you that. It's not the most healthy looking OBV ever, but look at the scooter moving right into that hot zone. And again, the PMO looks really quite healthy. So I'll forgive the OBV for not really confirming as much as I'd like to see. All right, RCL, Royal Caribbean, came up. Well, no, RCL did not. Oh, that was part of Oracle. The last one I have is PHG. Sorry for the confusion there. Nice little flag formation. Looks like we've covered most of that gap. PMO is rising, although it is decelerating on this decline. It's still rising strongly. I still like it. OBV looks great. And there you go with that scooter moving to the upside. Those were the charts I had. What do you have?
Okay, I'm going to start with a chart that I meant to bring up for everyone in that last segment, but didn't. So let me go ahead and start there. And that is healthcare. I actually left out healthcare for a reason. I didn't have it on either one of those charts. And I had this longer term chart up on healthcare. So the XLV versus the S&P 500, you can kind of see that it goes through these huge moves to the upside, and then followed by these very, very quick, not really quick, but just extensive moves. So for instance, in 2018, you can see the XLV, the outperformance here was just spectacular for about 6 or 7 months, and then followed by exactly opposite spectacular action to the downside. And now we're back in this uptrend. And so I want to watch these moving averages, but healthcare, you know, on the surface, you think of it as being defensive. I look at maybe pharmas as being defensive. I look at biotechs as being very aggressive. And then I look at the other areas like medical equipment, medical supplies as maybe being somewhere in between on the two, maybe a little bit more toward the aggressive side. So when I see the healthcare group outperforming like this for a couple of months, as long as this uptrend remains in place, this is an area that I would want to stay focused on. So with that thinking and backdrop, I want to point out a couple charts here, well, several charts that you know, I think I can highlight some of the strength that we're seeing. So for instance, on Dentsply, X-Ray, XRAY, this is a stock that is in that healthcare space. So if healthcare continues to move forward like it has the last couple of months, because this is a stock that was doing very well relative to medical supplies, even when medical supplies in the overall healthcare group were going down relative to the S&P 500. So you already had a strong stock. And when the money rotated into the group, that's when we really saw the stock begin to take off and is now at a 52-week relative high to its group. So a stock like X-Ray is going to be one that I'm going to keep on my list. And the way I pulled these up is from the Scooter report that is in your dashboard. So if you go over to Scooter reports right here, and all I did is I started with healthcare. And you can see all the healthcare stocks listed in Scooter order. Top one was X-Ray. So that's how I'm using the Scooter to find stocks based on what's going on in the market, which is outperformance from healthcare stocks. So that is going to be how I came up with a number of these stocks I'm going to show you. The next one is MTD, Mettler Toledo. And on the relative chart again, you can see breakout. The stock on a relative basis was already performing well, and now healthcare is getting in favor, and look at the breakout to a new 52-week high in MTD. Next up, IQV. IQV, big breakout. Look at the volume coming in to support this. Great support at 145. Your 20-day moving average is right there. Again, this is another one that's been one of the top scooters in the space, and you can see why. This is a great way to point you toward, especially if you're more of a momentum type trader. If you're a value investor, scooters are ranking based on tactical price action. So it's not going to put them in order of valuation. It's going to do it based on momentum and relative strength. So that's what the scooter is designed for. And so if you're not a momentum trader, you may not find as much value in it. But I think it is a tremendous tool in terms of value. Here, Danaher pulling back over the last 4 or 5 days, but look at the relative strength. The group is broken out. to a new absolute high. This is one of the best performers in the group. 20-day test to me would be a no-brainer. SYK, another one breaking out, another one with very strong relative strength moving up here in June. A beautiful breakout. 20-day test is what I would look for on Stryker. Edwards Life Sciences, EW, hasn't made the breakout yet, but that's a pretty nice looking chart. Maybe a cup, pull back again. That 20-day moving average is going to be interesting. Volume trend strong. BSX, Boston Scientific, another one making a big move to the upside. If this has a negative divergence, we might get a 50-day test because the volume is coming out on this last high to the upside. So I'd probably want to look at the PPO and see if it's actually lower on this high. So maybe a little bit of a weakness there. But overall, again, you got a stock that was moving up on solid volume and one that I think longer term will do well. Last two I have Abbott Labs, ABT. After a big move up, nice volume, good, strong relative strength, we are pulling back. Use this weakness as an opportunity. 20-day moving average would be the first entry. Second entry might get back to test this price support level down closer to 80. And then the last one, DXCM, this is Dexcom. Beautiful move up. Look at all this overhead resistance near 155. Beautiful test of that 20-day moving average. Relative strength, not all that great, but if we could get a breakout above 155, that could easily change, especially if volume comes in. So those are the stocks that I have, and we will pull up our summary for this final segment. Scooter report. Erin showed you a number of different stocks based on her scooter scan and using healthcare as kind of my backdrop, a number of stocks that I think are worthy of your attention for trading as we move in here toward the end of June. Can't believe June's almost up.
I know, it really, June went very quickly. July is already next week.
Yeah, I mean, it's pretty amazing. I mean, half the year, half of 2019. Didn't we just celebrate?
I know, exactly. I know we were going through our expectations for the year. It seems like yesterday.
Yeah, but 2020, next, when we come back next week and start doing our show, we'll be in the second half of 2019, heading for 2020. That's unbelievable.
I know. Loving every minute of it, Tom.
What's that?
Loving every minute of it.
You have to enjoy every minute for sure. Looking at the market here, just a quick final update. You can see the Dow Jones Industrial Average up 67. Nasdaq, even though it is, been sliding since the early action, is still up 43 points. S&P only up 3 now. Russell 2000 flat. There are some signals that tell me, we might go lower, but the fact that we're not seeing the aggressive group selling off during this move to the downside, like I showed on that 60-minute chart, makes me think maybe we bounce back quicker, but we'll see. All right, it is time to wrap up another show. I do want to thank all of you for being with us today. It's always a pleasure to have you joining us here at Market Watchers Live. Please remember to complete the survey as you exit. It is located below your video player. We do love to get your feedback. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody, and we will see you back here tomorrow. Happy trading.